Hello students, welcome back for the part 6 session of capital gains for final year BCom students. In the previous sessions we have learned about the exemptions which is under section 54, 54B as well as 54EC, and today's session we are going to discuss on the other exemptions which is under capital gains. Along with that, some illustration we are going to solve for those exemptions. Let us start with it. The first exemption, which is under section 54F, the first condition need to be satisfied by the assessee, that is sale of an asset in the previous year. Here the sale of an asset should be any long-term capital asset, but it should be other than residential house property. So any long-term capital asset can be sold, but that particular long-term capital asset should not be residential house property. The second condition, that is a purchase of new asset or investment need to be made by the assessee, that is he can purchase any new residential house property or he can deposit in capital gain account scheme. Any one option he can go with the investment, and that investment need to be done, that is time limit. Third condition, time limit to purchase new asset. That residential house property can be purchased within 1 year before the sale or within 2 years after the sale. If the new house property is constructing, then it should be completed within 3 years after the sale. If above 3 conditions are satisfied, then the assessee will get exemption. That is, if the cost of new purchase is more than net sale consideration, then he can get an exemption as gross capital gain. That means if the cost of new investment, what is going to purchase as a residential house property, if that cost is more than the net sale consideration, what we are going to do, gross sale consideration less realization expenses, after that we'll get net sale consideration. If the cost of that new purchase is more than the net sale consideration, then the exemption amount will be gross capital gain. Whatever the gross capital gain we will get in the illustration while solving that illustration, then we can take the full gross capital gain as exemption. If the cost of new purchase is less than the net sale consideration, then we are supposed to use this formula, that is gross capital gain divided by net sale consideration into cost of new purchase. If he has done deposit, that will be also added for that. Then in the last, if that particular new asset sold within 3 years, whatever the earlier exemption he got, that will be charged as short-term capital gain, and for that he need to pay the tax in the year which he is going to sell. Remember, sale should be any long-term capital asset, but it should not be residential house property. Purchase should be residential house property or deposit can be done. If both sales and purchase is a residential house property, then it will be a different section. That is the reason sale should be any long-term capital asset, but it should be other than the house property. Let us see how this exemption will work by solving one illustration. Professor Raj, a resident, enters into partnership with 3 other persons on July 1st, 2018 to start a manufacturing business. The following capital assets are contributed by him as capital contribution. Date of acquisition, here in this illustration we have 2 assets, one is gold and one more is unlisted shares. Date of acquisition 10/6/2002 and 2/11/2003. Fair market value on the date of transfer, that is nothing but market value on the date of sale, 6 lakh, 3 lakh. Amount recorded in the books of the firm, whatever the amount they have sold, that has recorded in the books, that is 5,90,000 and 8,50,000. Then we have cost of acquisition 2,10,000 and 2,70,000, that is nothing but purchase amount. On 10th April 2019, he completes the construction of residential house for which he spends rupees 10,40,000, that is the new purchase he has made. Determine his net income from capital gain for the relevant assessment year 2019-20, and then we have cost inflation index for the year 2001 and 2, for the year 2002 and 3, and for the year 2003 and 4, and lastly 2018-19 index number we have. In this illustration we have 2 capital assets. We need to either you can make 2 particular formats for that, or in one particular format only you can make 2 columns for 2 capital assets. Let us solve it. First, we are supposed to take the taxpayer or the assessee name. In this illustration, we have Professor Raj is the assessee or the taxpayer. Let us see the computation of taxable income from the capital gain of Professor Raj for the assessment year 2019-20. I have made two columns for two capital assets. Let us see what capital assets we need to take first. In the illustration, we have two capital assets. One asset is gold and one capital asset is unlisted shares, as you can see here. First asset is gold. Let us take when it is purchased and when it is sold. Purchase is on 10/6/2002. Sold is on July 1st 2018. Let us see whether it will come under short term or long term. As gold will come under the category of other assets, it will be considered as long term because the duration is more than 3 years. Then unlisted shares, we have the purchase date on 2/11/2003. Sold is on July 1st 2018. The duration for this we are supposed to check as 2 years because unlisted shares will come under the category of unlisted shares only. For that we need to check duration 2 years. It is more than 2 years, then that is the reason it will be unlisted shares as long-term capital asset. As we are having two assets, I need to mention the asset name also along with which type of capital asset it is. First, we need to take sale amount, that is gross sale consideration. In the illustration, they have not specifically said the sale value or transfer value on the particular day, but we have two information. One is fair market value on the date of transfer. This is the market value which is on the date of sale. Then amount recorded in the books of the firm. Whatever the sale they have made, that amount which they have recorded in books of the firm. When we are taking the sale amount, if we are having the market value on the particular day of sale, the taxation department will consider that value only, because sometimes due to avoidance of tax the value may change. That is the reason the tax department will consider the value which is on the sale day. But in this illustration we have market value on the date of sale as well as which is the amount recorded on the books of the firm. In this situation we are supposed to take the books of the firm, not the market value which is on the date of transfer, because amount which is recorded on the books of accounts or books of the firm will be considered as documentation when the auditor came to verify. So he can easily verify that what is the sale amount which will be recorded in the books of a firm. As they have mentioned it is a partnership firm, we can easily say the amount we are supposed to take, that is amount recorded in the books of the firm, not the market value on the date of transfer. So let us record it. For gold 5,90,000, for unlisted shares 8,50,000. Then we need to record with realization expenses. As you can see in the illustration, we don't have any expenditure which is on the sale. On the day of sale they have not spent any money. It will be nil, both the assets. Then net sale consideration will be same, 5,90,000 and 8,50,000. So this is the sale amount what they got. Then we need to take indexed cost of acquisition, that is purchase cost. In the illustration they have already given cost of acquisition 2,10,000 and 2,70,000. Before that we need to check whether it is purchased before 2001 or after 2001. Both the assets which is purchased after 2001, as you can see here. If it is after 2001, we need to take what is the purchase amount divided by respected year index number into 280. So I am doing that by taking working note. Index number also they have already given the illustration, 2002 and 3 105, 3 and 4 109, and 2018-19 is 280. So I have done in working note. Index cost of acquisition, gold which is also after 1/4/2001, 2,10,000. Which is on the date of acquisition they had index number 105 into 280. I'll get 5,60,000. Same will be applicable for unlisted shares which is also purchased after 2001, 2,70,000, 109 into 280. I'll get 6,93,578. I have done those calculations as a working note. You can do also in the same manner. So let me record that amount, which is gold amount of index cost of acquisition is 5,60,000. Then for unlisted shares 6,93,578. Then we need to require with improvement. In the illustration, you can see we don't have any improvements which is made on gold as well as unlisted shares. So index cost of improvement will be nil. We need to do the total. We are going to get gross capital gain, that is 30,000 and 1,56,422. Next, we are required with exemption. First, let us check whether the new investment which is made by the assessee or not. As you can see in the adjustment on 10th April 2019, he completes the construction of residential house for which he spends rupees 10,40,000. As well as we have two assets, gold and unlisted shares, and they have not said for which capital asset this exemption will be applicable. As we are having two assets, the sentence or investment will be applicable for both the assets. So first let us check whether that asset will qualify for exemption. One by one we'll check for gold as well as unlisted shares. So let us see the exemption list first. What are the conditions? First condition is sale of an asset, any long-term capital asset, but it should not be residential house property. If you are checking for gold, gold is a long-term capital asset and it is not a residential house property, then it will be satisfied. Then let us check the second one, purchase of new asset. It should be new residential house property. As you can see in the illustration, they have they have constructed a new residential house. As I told you, construction can be also applicable, so it is also satisfied. Then the third condition, it should be purchased. So here they have not purchased, they have constructed it. It should be done within 3 years. It is done on 10th April 2019. As you can see, sold is 2018 and completed is on 2019. So definitely it will be applicable and this is also satisfied. Then we can go with the exemption. Let us check for second capital asset, that is shares, unlisted shares. First condition is sale of asset, any long-term capital asset other than residential house. It is not a residential house property, then the first condition is satisfied. It is also long-term capital asset. Then let us go with the second one, purchase of new asset. So new residential house property or deposit in capital gain, as the residential house property is going under construction, it is also satisfied. Third one is time limit and it is also purchased within the stipulated time. Then the third condition will be also satisfied. So here exemption will be applicable for both the capital assets. Exemption under section 54F will be applicable for both the capital assets. So both the capital assets satisfied all the conditions, then it will be applicable for both. If it is applicable for both, then how can we distribute that exemption for both the capital assets? That is the next question. So that is the reason when we are distributing exemption for more than one capital asset, then we need to go with the preference basis. We need to give first preference for one asset, second preference for another asset, third preference for one more asset, like that we can go on. So here also we are following the same manner. We need to give the preference for first particular asset and then we are going to give preference for other capital asset to distribute that exemption. So how to find out that preference? Which asset can be first and which asset can be second? So that we are going to find out by using one particular information. As you can see here, exemption under section 54F, order of preference. Which order we can give the preference while distributing the exemption. I have used a simple formula, GCG, that is nothing but gross capital gain. I have used a short form, NSC, that is nothing but a net sale consideration. You can see in the format itself, and I am multiplying with 100 in order to find out percentage. For gold, gross capital gain is 30,000 divided by 5,90,000 is the net sale consideration and I am multiplying with 100. I'll get 5.08%. Then for unlisted shares, gross capital gain is 1,56,422 divided by 8,50,000 is the net sale consideration. I need to multiply with 100. I'll get a percentage of 18.40. So as you can easily say, first preference we can give to unlisted shares. Then other preference, that is the second preference, we can give for gold. So while giving the exemption, first we are going to give the exemption for unlisted shares. If any amount which is left from the exemption, from that amount we can give the exemption for second asset, that is for gold. So let us calculate exemption for unlisted shares first. First, let us see how exemption need to be given. Amount of exemption can be given, in which way of any one can be applied, because both cannot be applied. First we need to check if the cost of new purchase, that is whatever the construction they have done, on that cost we need to compare with net sale consideration what we got. If cost of purchase is more than net sale consideration, then whatever the amount of gross capital gain we got, that will be exemption. If the cost of new purchase is less than the net sale consideration, then we need to use the formula, that is gross capital gain divided by net sale consideration into cost of new purchase. If they have made deposit, that will be added for that. Let us start with the calculation of exemption. We are going to start for unlisted shares, that is the first preference we are supposed to give. We need to check whether the new purchase is more than net sale consideration or less than net sale consideration. As you can see here, unlisted shares, the purchase cost is 10,40,000, that is the house construction cost of the house, which is more than 8,50,000. As you can see, net sale consideration for unlisted shares is 8,50,000. The amount of purchase or construction of house property is more than 8,50,000, that is more than net sale consideration, then we can easily apply the exemption as gross capital gain. Here the exemption amount will be gross capital gain amount, that is 1,56,422. that will be the exemption. And remember one thing, here on the first preference we are given exemption for 8,50,000. we have a total investment of 10,40,000. On that total investment we have already given the exemption for 8,50,000. whatever the income they got, that will be considered. 8,50,000 we have already given the exemption. For the left out balance we are supposed to give for second capital asset, that is for gold. Now we can see I have calculated for gold. First let us check the left out amount. 10,40,000 is the investment. I have already given exemption for 8,50,000. Left out is 1,90,000. So we need to consider investment as 1,90,000 because some exemption which I've already given there. So 1,90,000 amount we are supposed to consider as investment for this exemption. Let us check the condition now, whether it is more or less. Investment is 1,90,000 and net sale consideration is 5,90,000. If you compare, 1,90,000 is less than 5,90,000. That is nothing but new purchase is less than net sale consideration. Then we need to apply the formula, that is gross capital gain divided by net sale consideration into new purchase cost. Gross capital gain is 30,000 divided by net sale consideration is 5,90,000 into new purchases 1,90,000. We are supposed to take new cost or investment is only 1,90,000 because the exemption up to 8,50,000 we have already given. The left out is 1,90,000. For that we are taking exemption. We'll get an exemption amount of rupees 9,661 rupees. Let us record that exemption. For gold 9,661. For unlisted shares the entire gross capital gain 1,56,422. Net capital gain will be 20,339 and unlisted shares will be nil. Let us go with the next exemption under section 54GB. Sale of new asset in previous year should be residential house property or land, but that residential house property or land should be long-term capital asset. Then purchase of new asset should be any new equity shares on eligible companies. Eligible companies can be a manufacturing company where the investment in plant and machinery should be more than 25 lakhs, but it should be less than 10 crores. And other companies like any startup company can be also eligible for this, but that startup company should be started or incorporated after 1st April, that is the previous year which the asset is transferred. And if you talk about time limit to purchase those shares is within 1 year after the sale. When the sale made, after that within 1 year it should be purchased. Remember, after the sale happens, the assessee can purchase shares within 1 year. When the shares is purchased in the eligible companies, then that company can use that money only for the purpose to purchase new assets. That should be also done within 1 year. Then if the three conditions are satisfied, then we are going to go with the amount of exemption, that is also similar to 54F. If the cost of new purchase is more than net sale consideration, then exemption will be gross capital gain. If the cost of new purchase is less than net sale consideration, then the exemption will be a formula. After that, if that new asset, that is the new shares, which is sold within 5 years, then whatever the earlier exemption they got, that will be chargeable to tax when the shares is sold. Let us start with one illustration. Mr. Prasad sold a residential house property for rupees 12,10,000 on 15th May 2018. The indexed cost of acquisition of the property of rupees 2,27,500. In the illustration, they have already given the indexed cost of acquisition amount, that is purchase cost, along with the index. There is no necessity to calculate again with the index numbers. Mr. Prasad holds 51% shares of ABC Limited on 1st December 2018. On 1st December 2018, he purchased the shares, that is 51% shares in ABC Limited. The total investment made by the Prasad in ABC Limited is rupees 8,50,000. The shares value is 8,50,000, out of which the company make the following investment. From that 8,50,000, the company had made some investments, which is on 1st March 2019 invested a new plant and machinery for rupees 4,20,000. On 10th July 2018 invested a new plant and machinery for rupees 1 lakh. On 31st March 2019, amount deposited in LG, that is a company, deposit account rupees 2,90,000. Compute taxable capital gain of Mr. Prasad for the assessment year 2019-20. The assessee or the taxpayer is Mr. Prasad. The heading will be computation of taxable income from capital gain of Mr. Prasad for the assessment year 2019-20. First, we need to check which capital asset is sold, that is residential house property. This is the residential house property which will come under the category of land and building. We need to check purchase and sale date. That is not necessary in this illustration as they have already mentioned as index. If they have already mentioned as index, then we can easily say this capital asset belongs to long-term capital asset. Then we need to start with gross sale consideration. We are supposed to take the sale amount which is in the previous year. That is the amount of rupees 12,10,000. That is a sale amount which is made on 15th May 2018, which is in the previous year. So let us enter it, 12,10,000. Then we need to take realization expenses. This is the amount which will be spended in order to do the sale. As you can see here, there is no realization expenses or selling expenses which is made on the sale of that asset. So the realization expenses will be nil, and the total will be net sale consideration with the same amount, 12,10,000. Then we are going to enter with the indexed cost of acquisition. We are supposed to less, as in the illustration they have already given directly, that is indexed cost of acquisition amount they have already given mentioned as a direct amount. Then we can take the same amount which is mentioned in the illustration, the indexed cost of acquisition of the property, that is 2,27,500. There is no necessity to calculate the formula by using index number as I have mentioned directly. Then we need to go with the improvement. The illustration, he has not made any improvement on that house property, then it will be nil. Then the total, that is a gross capital gain amount, is 9,82,500. Then we need to go with the exemption. For that we need to check whether they have made any new investment or new purchase. The illustration you can see he has made one new investment, that is Mr. Prasad holds 51% of shares of ABC Limited on 1st December 2018. So he had made the total investment, that is 8,50,000 on ABC company. The company has used that amount for three different purposes. They have already given the purpose also. First, let us check the conditions first. First condition is sale. It should be residential house property or land, but it should be also long-term capital asset. You can see in the illustration what we have solved. The residential house property is the asset and it is also long-term capital asset. Then we can say the first condition is satisfied. Then we need to check the purchase of new asset. It should be new equity shares which is on eligible companies. In the illustration, the assessee, that is Mr. Prasad, has invested 51% of shares in ABC Limited. They have not given any information about the company, so let us assume that is also eligible company. So he has made a purchase. Then we can say the second condition will be also satisfied. The third one, that is time limit to purchase new asset, it should be within 1 year. After the sale, the purchase of that shares should be done within 1 year. Let us check it whether it is done within 1 year or not. On 1st December 2018, you can check the sale is on done 15th May 2018. Within 1 year itself, the investment is also made. Then I can say that particular condition is also satisfied. We need to apply with the amount of exemption. We need to check the condition whether new purchase is more than net sale consideration or new purchase is less than net sale consideration. So exemption will be 54 GB. First, let us check how much investment which is made by the assessee in that company as shares. On 1st December 2018, he had made a investment of 8,50,000. But in this illustration, they have given how the company has utilized that 8,50,000 into different purposes. As they have utilized that 8,50,000 for three different purposes and also many more, but they have also only mentioned three. If they are mentioned like this, we are not going to take the investment what he has made. We are going to take from that investment what particular money used for which purpose, that will be considered. As I told you, whatever the investment which will be made by the assessee in that company as a shares, that money should be utilized by that company only to purchase new assets or can deal with any activity which is related to investment in new assets. As we are having three particular purposes they have already given in the illustration, let us check whether that will apply. First one, on 1st March 2019, invested in new plant and machinery 4,20,000. The date is also within 1 year and it is also a new asset, that will be applicable or satisfied. Second one, on 10th July 2018, invested in new old plant and machinery for rupees 1 lakh. Date is before the purchase and it is also old asset, then it will not be qualified. Then on 31st March 2018, amount deposited in LG. So they have deposited within 1 year only after the purchase. Then it is done in LG. So it is a company where dealing with assets. It is also qualified. So only two amount will be qualified. We are supposed to take 4,20,000 plus 2,90,000 as new investment. So total investment is 4,20,000 plus 2,90,000, that is 7,10,000. We need to compare the total investment with the net sale consideration whether it is more or less. So let us see, 4,20,000 plus 2,90,000, 7,10,000 is less than the net sale consideration, that is 12,10,000. So if it is less than the net sale consideration, you are supposed to use the formula, that is gross capital gain divided by net sale consideration into cost of new purchase, not the first one because it is less than the net sale consideration. Let us calculate that exemption amount. 9,82,500 divided by 12,10,000 into 7,10,000. You will get an amount of exemption is rupees 5,76,508. The net capital gain after deducting that 4,05,992. Apart from this, we have three more exemptions. One is exemption under section 54D. Under that, first condition is a sale of asset in previous year. It should be land and building, and that land and building should be acquired by the government. Instead of selling that land and building will be acquired by government, and the government will give some compensation. That is also income. For that income also tax will be paid. But whatever the land and building will be acquired by government, that land and building should be utilized for industrial purpose by the assessee at least for 2 years before the government acquired. Then the second condition is purchase of new asset. The purchase of new asset can be any new land and building or can be deposited in capital gain account scheme. Any one can be done, or both investment can be done. The time limit for to purchase that new asset, it should be purchased within 3 years after the date of sale. Then the amount of exemption will be similar to the first exemptions what we have done, that is cost of new purchase. If they have done deposit, that will be added for that, or gross capital gain, whichever is the least, will be considered for exemption. Then if that new investment what they have done on land and building, if it is sold within 3 years, whatever the exemption they got, that exemption will be charged to tax under short term capital gain in the year when the land and building sold. The next exemption is under section 54G. The sale of asset in previous year, it should be land and building or can be plant and machinery. But when the company or industry is shifting from urban area to rural area, on that time, if these land and building and plant and machinery is sold, then they can get this exemption. Remember, when the industry or any particular company are shifting from urban area to rural area, on that time, if they sold this land and building and plant and machinery, for that the exemption will be 54G. If the first condition satisfied, then purchase of new asset can be in new land and building or plant and machinery, or can be deposited in capital gain account scheme. Time limit for that, it should be purchased within 1 year before the sale, or it can be purchased within 3 years after the sale. If first 3 conditions are satisfied, amount of exemption will be there. Cost of new purchase along with the deposit or gross capital gain, whichever is the least, will be considered for exemption. If that new asset which is sold within 3 years, then whatever the exemption they got, that will be charged to tax when the particular asset sold. The next exemption is under section 54GA. On that, first condition is sale of asset in the previous year. It can be land and building or can be plant and machinery. But when an industry or any manufacturing concern or any company is shifting from one particular area to special economic zones, on that situation, if they are selling land and building and plant and machinery, they will get income. For that income, the exemption will be applicable as 54GA. Second one, purchase of new asset can be new land and building or plant and machinery. Time limit for that, it should be purchased within 1 year before the sale, and it can be also purchased within 3 years after the sale. If the first 3 conditions are satisfied, then they will get amount of exemption as cost of new purchase divided or gross capital gain, whichever is the least. Here we don't have any option to deposit in capital gain account scheme. And the last one, new asset sold within 3 years. Whatever the exemption they got in the previous year, that will be chargeable to tax when the particular asset is sold. I'm not solving any illustration for these 3 exemptions, but you should know about it. For the rest of the exemptions, I've solved each illustration for each exemption. So I hope you guys have understood these all exemptions. If you are having any doubts, please mention in the comment section. I'll try to clarify it. And thank you for watching.